The effects of decade-long government and monetary policy stimulus are showing signs of wear and tear, with economic data in the US turning back down of late, stoking fears over the outlook for the global economy. Of all the indicators, the US NFP indicator has been one that has been quite robust and encouraging over the years, and yet here too we've seen a deterioration in 2019. Although the NFP numbers are still sufficient with respect to reflecting healthy levels, the market can't be feeling good about the fact that the 3-month average for NFPs was 245K back in January and now sits at around 155K. For quite some time, we had said NFPs were no longer expected to have any material influence on price action, given the fact that the numbers were already quite high and weren't going to have any influence on Fed policy that already had plenty of reason to be looking to raise rates if it were up to NFPs alone. But now that NFPs are sliding, they could be relevant yet again, and for reasons that are far less encouraging this time round. We have spent a lot of time highlighting the fact that NFPs were able to look as healthy as they did for so many years as the data was propped up via the assistance of government and central bank efforts. And so now, with all those resources used up, we are feeling the impact with NFPs no longer benefiting from proponomics. At the same time, we would be worried about a downtrend in NFPs that is accompanied by even the slightest of uptrends in hourly earnings. Hourly earnings have been the one indicator the Fed hasn't been able to do much about, and if hourly earnings start to trend higher, it could serve as a warning sign of inflation. And the combination of inflation and a drop in NFPs is the type of thing the market won't be wanting to see, as it will put a lot more pressure on the Fed to be thinking against additional interest rate accommodation. As far as today's data goes, the market is looking for NFPs to tick up from 130K to 145K, for average hourly earnings to tick down month on month from 0.4 to 0.3%, and for the unemployment rate to hold steady at 3.7%. If we see NFPs disappoint and hourly earnings come in firmer than expected, this would be a negative for risk markets. At the same time, if NFPs tick up and hourly earnings are subdued, we don't necessarily see all that much room for a big bounce in stocks, particularly with the market still very much worried about uncertainty around U.S. trade policy. Of course, volatility around the U.S. jobs report will also be mitigated by the fact that the market will be waiting to hear from what Fed Chair Powell has to say later on in the day. In truth, the Fed Chair's appearance could ultimately render the jobs report a lot less meaningful than what might have been. That's all for now.